I think it provides some fuel for the market to go higher here. You know,
if we get a deal, you mean?
I think we're going to, and I think the consensus that we've seen so far is that, okay, even if we get a deal, it's going to be a bad deal or one without substance. Our take's a little different. What we think has happened is the United States has slowly but surely gotten leverage here. First, by, you had the Huawei situation that gained some leverage and the attention of the Chinese. Secondly, the midterms where the president outperformed in soybean country. Third, the Mueller report. And then fourth, when he walked away from the North Korea summit. We think that all of those things have made it more likely that we get a deal of substance, and it's going to do two things. It's going to increase confidence at home, which will allow CapEx to restart in the U.S., and all that stimulus that China's put into their economy, once their companies know the rules of the game, we think that's going to be like jet fuel that kind of restarts their global growth.
What if we don't get a deal? What if the president says, you know what, they didn't agree to this, forget it, we're done, more tariffs?
Yeah, I think then you got to take your earnings estimates down a little bit, right? Because if tariffs are going to go from 10% to 25, then obviously that's going to be higher input costs for companies. You got to reevaluate your earnings.
Do you sell stocks then?
I think you would expect to see some retests to lower levels. I don't think that's the end of the world. I don't think that necessarily brings on recession, but you got to
immediately ratchet down GDP estimates, I assume, earnings estimates.
GDP, earnings estimates, you probably take a little bit off your PE ratio. Again, we think that's a very low probability, but you'd have to respond to that.
I mean, listen, when it comes to investing, you have to account for all probabilities.
Absolutely.
If it's small, fine. And you weight against that, but you have to account for it. You're optimistic a deal will be reached.
Yes.
The question, I guess, everyone's asking is a deal already in the market?
No. No. What we think is...
Why do you say that?
I'll tell you why. Because what we think is what's in the market is a bad deal, that this just gets off the table. The idea that we're going to see a reacceleration of economic growth is just starting to kind of eke its way into the market over the last couple of days. The idea that the stimulus in China isn't pushing on the string, but could actually take global growth back up.
Well, China's market's up 30% this year.
Yeah, but look at what's going on in Europe, and Europe is a derivative play on China. If Chinese growth really starts to accelerate, you're going to see exports out of Europe do better. You're going to see global growth estimates go higher, and we think that can take you to and then past the old highs.
So that's interesting. So Europe as a derivative play on the China trade deal, because a lot of people don't realize the collective Eurozone economy is about the same size as the U.S. economy.
And it's an export economy and to a large degree, selling to us and to China. They have a lot of exposure in the luxury goods space and the service, not in the service space, in the manufacturing space to emerging markets.
Just quickly, let's get some opportunities. What sectors, industries still look good to you and your team at Federated?
Yeah, so we like cyclicals in the U.S., things like energy, materials, home builders, semis. They've all run, but they're still well below their old highs. Dividend payers, small caps. Those are our three kind of key areas.